Hello and welcome back. My name is Josh, and today I want to discuss why it's so important to do your own research and not take service level numbers. So, this is a perfect example. I was speaking with a friend the other day about Shopify. They're a shareholder. They were saying to buy more. I previously was a shareholder. Full disclosure, I no longer own. I bought in about, um, if this is the Canadian shares, yes, these are the Canadian shares. They both trade in Canadian dollars and on the NASDAQ in US dollars. I own the Canadian shares. I bought it at about 1,000 right here around May 15th. I think I bought 5 shares, average price just over 1,000. I sold out right around here in September, around $1,800. So I made a decent profit on it. And since then, obviously, it's down 60%. Not that I'm a genius. I've held a lot of losers, and it's been a tough couple weeks for tough couple months for a number of stocks here. You can see, you know, we actually look at QQQ, which is the Nasdaq, in the last, let's say, month. Let's go here. Since January, since the start of the year, Nasdaq's down 16%. That's about matches how much my portfolio is down since then. So you could say it mimics the Nasdaq. But yeah, it's been a tough couple of months for growth and for tech, partly because of inflation, partly because of fears of rising Fed and uncertainty around Ukraine, Russia war. So back to Shopify though. I was saying, oh, you know what, I sold out. I saw that there was, I thought it was a little overvalued. And with coming inflation, I want to sell out of that. And they had a super high PE. And he said, no, you got to buy back in, man. The PE is really low. It's like really reasonable at 26 times. I was like, there's no way that's the case. So anyway, I was talking, I looked into it. I said, holy shit, it says a PE ratio of 26. Now, I have a video, I'll link to it here, discussing in more detail what these terms are, but just as a refresher, P is price to earnings ratio. It's typically it's the price per share divided by the earnings per share. But another way you could look at that is total market cap divided by total earnings. That's another way you can look at it. So I thought, wow. And otherwise, they had an amazing quarter. There's no doubt Shopify is an amazing company. It's just, is it overvalued? So, maybe at 26 times, it's growing. It grew 41% last year revenue. I don't know if you can see that. 41%, which is kind of crazy. Why is this? Yeah, the screen's giving me a little difficulty, but yeah, 41%. You can see here, 41% last quarter, year over year revenue growth. So, 26 times for a company growing that quickly is actually probably a fairly good value. So I said, how is that possible? So I did some research, and the numbers just didn't seem to add up. Let's just do a little spreadsheet here. So if it's 96 billion, again, this is Canadian dollars. If you're looking at Shopify, NASDAQ, NASDAQ, you're going to see different numbers. Just as a heads up, so stock, shop. Oh, sorry, it's not NASDAQ, it's New York Stock Exchange. Sorry. So here, you're going to see a difference. Here you can see it's only $600 because that's US dollars. You can see here it's US, this is Canadian. So if you think, why are his numbers different? It's because you might be looking at a different one. So here's 75 market cap, but still 26p. So again, you're just converting currencies, but it still should be the same kind of metric. So anyway, I'm going to use Canadian dollars because that's where I'm at. I'm in Canada. So again, if you have a 26.35, let's take that, price earnings. This is Shopify. That's their price earnings. And you have a market cap of 96.29 billion. A billion is 1,000 million, so let's go 96,290. So this is how many millions of dollars. Then you should have $3,654 million in earnings, estimated earnings, which is the same as just by 3.6 billion, just for everyone's sake. And this is when I did some research. So I decided to go into their earnings statement. And you can see here, they have revenues. Oh boy, this is not working out like I thought it would. Here you go. Let's move this around so we can all see a little better. Okay, so they had revenues of 4.6 billion, which was up from 2.9 billion the year before. Again, that's massive growth, and they still projected pretty solid growth. Then they have cost of goods, cost of revenue, gross profit. 2.8 billion is their gross profit. Then they had operating expenses, about $1 billion in sales and marketing, research and development, blah, blah. Total operating expenses, 2.2 billion. So their income from profit was 26843. Now that's in millions. So they had $268 million in profit from operating. On top of that, they had other income. So they had 15 million in interest income. So that means they probably had a bunch of cash just earning interest, right? A lot of companies hold a ton of cash on hand just in case there's a downturn, and they invest those in T-bills or bonds, and they earn a little interest on that. Interest expense, so sometimes they have to borrow money, and they have to pay interest on that. So they lost 3 billion on interest, but they gained 15 billion from cash on hand interest. So not a huge difference. And then you can see here a huge thing. $2.859 billion net unrealized gain on equity and other investments. And then foreign exchange gain. So again, maybe they do business in Canada and US and other places. Maybe they transferred money to the US and then the Canadian dollar dropped. So they actually got a gain. So the total income is 2.87194. So again, that's $2.8 billion. So this is the actual one. 2.876. So you can see my number's a little off. I said it should be about 3.6 billion. Again, these are rough. Actual earnings were 2.8 billion. So still a lot. But remember, of that, this is how much were total earnings. How much of it was actually from operating the business, which is really what you want to value. You want to value what the business earned. And again, we can see income from operations. That's how much the actual business earned. Unless the business is actually a company that invests in other things like Berkshire Hathaway, then I typically try to ignore these because those are not ongoing things. So, again, this is 2.8 billion or 2,876 million, and the operating income was 269 million. So of the total, remember this is total, only 9% of their income for the quarter, 9%, just over, was income from actually operating the business. The rest of it, this whole other bit, let's add another row, investing, was from investments. $2.6 billion. $2.6 billion from investments. Now again, was this money actually earned? Yes, there's no denying it. But unless your business is just making investments every quarter, which there are businesses that do that. You could say Berkshire Hathaway, owns a huge stock portfolio. Maybe you invested. There are businesses like that. If you expect that, then that should be counted as real earnings. But for most businesses, this part, the operating earnings, is the real earnings because that is the income from operating the business. It's almost like I own a building and while renovating, I struck oil. That's not gonna happen every time. So you should not count that as moving forward. So if we were to look at what the earnings would be, or what the PE would be, if we based it on just operating earnings, you can see the PE suddenly goes from 26 times to 358 PE. Now, just for context, Tesla, which people say is a hugely overvalued stock, I personally love it. I am a buyer. I'm a huge holder. Its PE is at 171. 171 is half of the current PE, the operating PE of Shopify. So again, I dug in. I said, what was this unrealized income expense? And it says it here: equity from other investments in Readily. Da 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 da. Sorry, here. In July 2020, the company, i.e. Shopify, received an investment in a firm as non-cash revenue consideration as a result of services rendered. Basically, Shopify worked with a firm, and instead of a firm paying them money, they gave them some equity. I believe they did a deal, yeah, here, in conjunction with this strategic partnership for Shop Pay. So Shopify has an app called Shop Pay, and a firm was a partner. And because a firm was the preferred partner rather than Klarna or one of these other buy now pay laters, a firm is a buy now pay later company, a firm said, we'll give you a bunch of stock in return for letting us be the preferred vendor in Shop Pay. And then on January 13th, 2021, a firm completed its IPO. As a result, the shares that they had went up in value, which resulted in the net gain of, what was it? $2.8 billion. That's, or at least the vast majority of it. I think it actually says that the unrealized gains were 1.8 billion. There were some other things that happened. They sold off some stuff that resulted in more money, but the vast majority of these earnings were from a firm stock. And if we actually look, a firm stock, again, that was on January 1st. So even since then, even since January 1st, it's lost 64% of its value. So unless Shopify sold, of that unrealized income, they just realized a 50% decline in it. So divided by 2. So next month they're going to see a $1.3 billion loss, i.e. unrealized loss, because they held the stock. Again, if they sold the stock, great. I don't know if they did or not. But yeah, this stock has been hammered lately. Wow. So I don't know more about that, but the point of this thing is, it's easy to look online and say, oh, wow, look, this has a high PE, or wow, look at this dividend yield. I know a lot of my friends go, look at the dividend yield, it's big, and they just buy. They don't do any digging into why. Why is revenue up? Why is the dividend very high? Why is the PE so low? That's really what you got to do. You got to ask these questions and you got to do the research. And sometimes it's boring. It's not fun to look into this stuff, but you'll see that the actual results are so different. Again, this is a order of magnitude. It's 13 times higher, your PE. You're paying a 13 times higher price than you think you are. So that's a massive difference. Again, it's like you said, I'm going to buy a house for $1 million, and then it turns out you actually have to spend $13 million on the house. So again, this is why you got to do your research. Hopefully this was interesting. Again, I right now I've been buying the dip and doing lots of research. That's really I've bought into the companies that I'm already holding. So I've bought some Tesla, some some Square. What else did I buy? I did buy some Peloton at the bottom as well. But right now, most of what I'm doing is this. I'm doing a ton of research into other companies and looking to buy, because as these companies go down, some of them that I really like the business, but I thought were overvalued, are starting to get into that sweet spot where you say, okay, it wasn't valued properly now, but now it might be a good deal. So that's what I'm doing. If you have some ideas for companies you want me to research or that you want me to take a look at, let me know in the comment section below. Thanks so much for watching, and talk to you next time. Cheers.